finance analyst and also 16 years of experience. So help me welcome our speakers, and I'd like to give Adjei the opportunity to introduce himself as I also get to other speakers.
Hi, good afternoon. My name is Adjei Gyimah. I am a development finance expert, like Veronica indicated. My background is in banking finance and now development finance. I'm in transaction advisory, especially green finance, and I'm happy to be here. Thank you.
Thank you very much. Also joining me today is Kwame. Kwame Ababio, you have the floor.
Yes, good afternoon where I am. Good to be on this platform. My name is Kwame Ababio. I'm the head of the Environment and Climate Unit at the African Union Development Agency, which is the development organ of the African Union. So in this role, I oversee our technical and policy work around climate and environment, mainly around the three main conventions, and providing critical technical and financial support to member states. My area of expertise is largely around climate policy and also around carbon markets, where I'm doing my PhD dissertation on.
Wow, congratulations and all the best with your PhD. Charlotte, welcome, and it's good to have a female on the panel. We are believers of gender equality and equity, so we love you there. You can introduce yourself.
Okay, thank you very much, Veronica. I am Charlotte Remteng. I am a consultant on climate change, energy. I have actually worked with various international institutions implementing projects on resilience, energy policy, and I was also lead consultant for the African Energy Dialogue, and I headed the policy and regulatory, the enabling policy and regulatory working group. So I've been working across the climate change and the energy sector. Thank you. I apologize for my that I might be having issues with my internet beforehand, but hopefully it doesn't.
Thank you. We hope you'll be able to go through. So maybe to kickstart off this meeting, I'll then start with you. As we head to Belém in November, which is COP30, what alliances and negotiating strategies can Africa use to shape its climate finance priorities? Firstly, that resonate globally, but also safeguarding Africa's interests. And should Africa really push for a minimal allocation of the agreed new collective quantified goal on climate finance?
Oh, that's a lot. I think we'll start with the last. I think the minimum allocation. I think Africa should push for a percentage share allocation, and this should be based on its vulnerability and also its finance gaps, the finance gaps. So we are talking at the political level, the political floor. Africa should push for a percentage share allocation. So we look at the adaptation, where 35 to 40% was earmarked for Africa for adaptation. So I think at the political floor, this can be pushed. This method can be pushed using our vulnerability and also our finance gaps. And I think at the negotiating level, I read your profile, and I think you're one of the negotiators. I think we can also go with the need-based allocation, where we look at our needs, we look at energy access on electrified population. So we basically come with a formula where we have on electrified population, we have a GDP capita, which indicates our limited fiscal space. We have, I think, our vulnerability, we are top. We are top on the vulnerability index. So all of these put in a formula and well calculated, we should not just go for the minimum. We should go based on our vulnerability and also our finance gaps. So I think that is my answer for the minimum allocation of the NCQG. And the other question was on
alliances and negotiating strategies.
Oh, yeah. First, at the regional level, I think the African Bank and the African Union, they have to help us on alliances. They are to, create a unified act and also bankable projects that prioritize affordability. It's mostly profits, but for us, we need affordability. So they have to, go upfront with a unified act and also bankable projects. And then I also think that we have to go with investments. We don't go for investments, big investments, for example, in grid. We go for decentralized off-grids, mini-grids that reach the rural areas and the low income communities. So basically, we can also create an alliance with G77 and China for, to push our vulnerability. We can also create an alliance with the Climate Vulnerable Forum and also the Small Island states, which push for the moral and political pressure on adaptation and also loss and damage. So I think these alliances plus the private sector and also involving the private sector and also at local level, at national level. So we need all of these alliances. If we push with the various aims under the alliances, we are going to, make a case for Africa.
Wow, thank you. Thank you very much for that response. Kwame, I'm coming to you now. I saw you also have a very strong background on environmental governance. What challenges stand in the way of meeting this new collective quantified goal? And what accountability mechanisms are needed to ensure its delivery and equitable access? So really, how do we define and structure these accountability mechanisms to really ensure its delivery and its effectiveness and ensure equitable access?
Yeah, thank you very much, Veronica, and thanks for also IPPG for inviting me to this webinar. If you look at the core objective of climate finance, and particularly within the context of the NCQG, it is supposed to help us move beyond the failed $100 billion promise that happened at Copenhagen and Cancun, and also to ensure that projects, particularly for the global south, the developing country parties, are established, they are predictable, and also they are stable in terms of its flow. And for this to happen, a number of issues need to be overcome. When you look at the challenges that we currently face, currently with the geopolitical tensions that are ongoing around the world, I think that is one of the major challenges that we face. We are seeing a lot of developed country parties moving resources away from climate, from development, finance, into other areas that they deem more beneficial to their society. So particularly around security. And then there is also a certain level of donor fatigue because they are competing domestic priorities, and this has led to a reduction in funding commitment. If you look at the Glen Eagles commitment that was made, I think in 2005, where countries were supposed to commit 0.7% of their budget to overseas development assistance. For many countries, they've not been able to meet that target, and many of them have even now reduced that amount. And then also, another challenge that we face within the climate finance architecture has to do with definitional and accounting problems. Now, what counts? When we're talking about climate finance, sometimes you see financing that is rehashed, repackaged as climate finance. You see financing that was intended to be development finance, repackaged and sent as climate finance. So those are some of the challenges that we face. And then also I'd like to highlight the challenge of the structural and access barriers. And this is very much embedded within the context of the common but differentiated responsibilities and respective capacities. And I'd like to zero in on the respective capacities. It is trite knowledge that many systems, particularly in the global south, are not as robust, they are not as rigid, they are not as complex as it pertains in the other parts of the world. So even having access to some of these financing mechanisms, it's a very big challenge. You look at financing from some of the global mechanisms such as the GCF and others, and the capacity to access these funds sometimes it's not there. So countries are hindered in their approach towards accessing these resources. And this also can be seen from the lenses of the complex bureaucracies that are in place before you're able to access resources. And then also being able to bypass the national systems, because many a times the funds from international partners and other mechanisms comes through international intermediaries, international development banks and others. In fact, there was a report in 2017 by the International Institute of Environment and Development, and then a later one by the Climate Policy Initiative, I believe it was in 2023, where they highlighted that less than 10% of all funds that were supposed to reach actual actors on the ground got to these actual actors. So it just gave us a recognition that there are too many middle players within the pipeline for climate finance. And so where the resources is needed the most, which is at the local levels, the resources don't get there. So these are some of the things that we'll have to look at because they are key challenges. You would rather that the money or the funds reach local actors at scale and at speed to be able to address the challenges that climate change poses. Then the last point I would like to highlight in terms of the challenges has to do with reporting. For instance, look at the $100 billion target under the Copenhagen-Cancun arrangement. You listen to the OECD and they tell you they are close to reaching that target. You listen to other entities like Oxfam who have done serious accounting of the resources and they tell you we are just about 30% of that $100 billion target. So that framework to be able to adequately track how much of these resources get to the countries also presents a very big challenge that needs to be overcome to be able to assess this. So I think these are a few of the challenges that I can enumerate that are preventing countries from meeting or assessing international finance, both at scale and at speed. And then in terms of the accountability mechanisms that are needed to ensure delivery and equitable access, I think we will have to focus particularly on simplified procedures that will enable countries that have very weak institutional mechanisms but are in need of the resources. Because more often what you see, even within the African continent, there are a certain group of countries that consistently are receiving support because in terms of their organizational structure and architecture, they are better organized than others. Meanwhile, the others are the ones that are suffering the most and who need the resources. So that also needs to be checked, and the capacity of countries to be able to access these international resources is key. And then finally, I would also want to look at a situation where we look at a grant-based target. If you look at the current architecture of global climate financing, we've seen a continuous reduction of grants. And this does not augur well, especially for countries where you have a lot of vulnerable communities. The grant-based system needs to be improved so that it actually reaches those who are in need, and so that they're able to address the issues that they face on a regular basis. So I think like a mandatory goal of, let's say, 50% should be set aside as grants, and then maybe the rest in the form of concessional loans or other categories. But currently, as we see it, there's a move towards more more loans than grants, and I think that kind of arrangement should be changed. Thank you.
Wow, thank you. Thank you very much. And that's a really mouthful of issues raised there. And these are the real challenges that the developing countries are facing. And what is really concerning is the dwindling of the grant financing. And we are asking, what are the other existing or possible innovative mechanisms that can support climate action? But you also realize that they are continuously going to indebt developing countries, with at least 30% of mostly highly indebted countries being in Africa. So these are the real challenges. And talking of accountability mechanisms, we are coming at a backdrop where we have been failing to account for our own 100 billion in the public sector in terms of how it has been moving from developed countries to developing countries. And now we want to look at the 300 billion, but also the second tier of climate finance, which is the 1.3, which then includes all other stakeholders. How do we get the private sector to really account for climate finance? And we are able to then track and say it is indeed climate finance. So we have a challenge, but well, we hope we're going to solve it and it will get better with time. But that's why the Baku-Belém roadmap is very important, to really say the 300 billion, how does it look like? And the 1.3 trillion, who is responsible and how do we get there? We missed on the burden sharing outcome for developing countries, but it's something that we need to emphasize on. But anyway, allow me to invite my colleague with equal experience as I am on really say, what is the role of the private sector and what can they do to deliver on both the financial targets, which is the 300 billion and the 1.3, and also to really share the policy and regulatory reforms that are needed to attract more investment. That is a real challenge, because you begin to say, we need enabling environment. How does it look like? Adjei, tell us about all these enablers and how do we attract this investment?
Right. Thank you, Veronica. First of all, it's important to acknowledge that the goals that are being set, whether you are looking at the midterm 2030 goal or you are looking at the long-term 2050 goal, cannot be achieved without private sector finance. And the reason is grounded in data. If you look at 2023, 2024, the chunk of climate finance has come from the private sector, just a little above 50% in 2024. And if you zero in to mitigation specific, then the percentage even rises further for the private sector investment that constitutes mitigation finance. So that is enough basis to say that without the private sector, the goals that are being set will not be achieved. Of course, the goals are not the bottom line of 2 degrees and then pushing it further to 1.5 degrees above pre-industrial is not a finance goal, but eventually finance gets us there. So that's supposed to be established first. Now, let's also realize that for a private sector actor, what is very important is number one, cost recovery. Whatever you put in, you must be able to get. At the barest minimum, you should be able to get that money out. And then secondly, you're looking at profit making as well in most cases. So that level of comfort for cost recovery, profit making is supposed to be assured. And that assurance comes from a number of things that need to be in place. So first of all, there is that de-risking element where in early stage investments, you are looking at public funds, grants, guarantees, and other philanthropic funds coming in to take up the early stage risk of most of the projects, be it mitigation or adaptation. And then when it gets to second, third tranche or rounds of fundraising, when the early stage risk has been dealt with, then the private sector gets comfortable to come in. Sometimes we don't see this. We don't see this because every entity, be it public or private, is looking for a demonstration effect. And usually the demonstration effect comes at the finish line. And the finish line is when the project has crossed all the risk barriers. Of course, there is no 100% risk-free point in project finance, but then you can de-risk as much as up to 70% past the early stage to operational phase. So if these public funds, philanthropic funds, and all those we know, MDBs and all, want to be part of the finish line every now and then to also claim some accolades and glory that come with getting to that finish line, then it means the private sector is crowded out. Because ideally, you would want to have these public funds start and then they pass the baton on at some point in the project. But that is not what we really see. Mostly these funds take it from the beginning to the end, and they are expecting the private sector to also start their own projects, fund their own projects, and start from the beginning to the end. That needs to change. If we keep going that way, then it means it's more competitive than collaborative. But if we want the private sector involved, then we need to move from being competitive, of course, in quote, competitive in quote, because sometimes these are unintended approaches. It's not like an MDB is trying to rub shoulders with the private sector, but even if it's unintended, in the end, that is what happens. So can we have these public funds starting off at the early stage and then passing the baton to the private sector at that point when they are comfortable? For example, a green bond. You can have a green bond and then you put it into tranches so that the first two tranches goes to public funds who can bear the early stage risk. So if it's geothermal, you are now doing your data, your observations, and we know for something like geothermal, you are going on for maybe 1.5 years, 18 months for that matter, and you are picking data. A private sector entity is not likely to use their funds to do that subsurface data collection for 18 months when there is nothing to show. It's not likely you find a private entity who is willing to do that. Or let's even talk about forestry, where you are now doing the tree planting and you are expecting a private entity to come in at seedling stage. You are procuring seedlings and all that. You will not find the typical private entity who is interested in cost recovery and profit making coming in at that point. So can we have a collaborative approach where in these two examples, for example, I've cited, you have the public funds starting, de-risking that early stage, and then the private sector comes in later. We could also look at other mechanisms where, for example, when you look at mitigation, most of the technologies in mitigation have now gotten to mature stages. You're looking at solar, onshore wind, which is also mature, not like offshore, and so on. Can we have that approach where these mature technologies, which are in tested markets, are given up for private sector for their comfort? And then other technologies like offshore wind, tidal energy, and so on. And then maybe the pure play adaptation projects, for example, are taken up by these grants and philanthropic funds and public money. That way, we give the private sector the kind of comfort they are looking for. Lastly, let's also look at it from a PPP angle, where you have the public sector coming in at the very early stage to de-risk. What kind of de-risking are we talking about here? We are talking about the bottlenecks that we find at institutional level. Can we use government machinery to clear the bottlenecks, which the private sector dreads so much at that very early stage? There are market failures, there are institutional issues. We use the public machinery to de-risk and then clear these barriers. And then the private sector can take over from there. So some of those collaborative mechanisms could also help us help the private sector to also bring in private finance to achieve these many targets that have been set. Thank you.
Well, thank you very much, Adjei. That's what I've always been talking about. Climate finance should be really fit for purpose. So that is a very important thing. And as we look at climate finance really being fit for purpose, we need to understand what type of financing should be supplied at what particular stage of the entire value chain of your project. So that's very important. And thank you for bringing it up. It also really resonates around the issues of blended financing. So where do we put private financing at a later stage when the projects are bankable or they are quality enough to really bring profit? But what is the role of the public sector financing and philanthropic financing? So these are really good elements. And I think as the negotiators pushing for climate finance, we are cognizant that public sector financing alone will not be sufficient to address the demands and the changes that are required in the climate change space. But at the same time, how can they be well structured in a way that they contribute to sustainable development and poverty eradication of the developing countries? Charlotte, allow me to come back to you. Building on what Adjei has said, we are seeing more funds flowing into mitigation projects. How can the continent ensure that climate finance is balanced between mitigation and adaptation, given the private sector's tendency to favor mitigation projects?
Thank you, Veronica. Sorry, like I said, the network is very unstable here. I think some climate finance should go to resilient infrastructure for internet, especially this side of Africa. So I think we can actually use public and concessional finance to absorb the risks and create revenue and also credible cash flows for adaptation. And with this, we kind of like, we come out with adaptation projects which are bankable. And then we create incentives and also we kind of like enable policies so the private sector can profitably and fairly, invest in resilience, because the tendency is that they actually go like Adjei said, they go for projects which are profitable. And so adaptation most of the time is not profitable. So they tend to go to the profitable side, which is mostly mitigation projects. So I think we can also, adopt a clear, I think, needs-based allocation. I think I've mentioned a lot about needs-based allocation, because we actually have to go according to our needs for these negotiations, for these arguments, and we put our needs on the table. And so we look at the country's vulnerability, we look at our NAPs, we look at vulnerability assessments, and then we translate these needs to a transparent split or something that targets, I think, national and sectorial pipelines. And so with this, the government can clearly, negotiate on mitigation and adaptation projects. And I think we can also do something like we create adaptation specific financial instruments. We can come out with something like maybe resilient bonds, climate resilience, blended funds or something, and also maybe outcome-based contracts. This kind of like, will attract adaptation, investment in adaptation projects. And I also think we need to adjust our policies and regulations. We have a serious issue in Africa with our policies being transparent and clear enough to attract projects, not only mitigation, but also adaptation projects. So we actually need to adjust these policies to align with investments. And I think we can do this by offering, tax incentives. We can expedite, permits for projects on adaptation. We can also strengthen, I think, domestic financial system, because we have been talking mostly about, the grants, the loans from elsewhere, but we can strengthen our domestic financial system, which we encourage local banks to actually develop adaptation lending, projects. And I also think that we can prioritize mitigation projects with strong adaptation co-benefits. For example, we could go with distributed renewable energy, which has really been famous now, which if we have the renewable energy which goes for mitigation, then the co-benefits that come with adaptation co-benefits that can also align with projects on mitigation. So I think this is going to actually, create a balance, between adaptation and mitigation, considering the fact that most investments from private sector tend to go towards where the money is. So the government can set all this pace, all the things I've listed, from having a clear needs, creating incentives that actually direct, these projects towards adaptation. And yeah, I think that is what I have to say with this. Thank you.
Thank you, and thank you very much, Charlotte, for that input. Indeed, I remember my boss said there are two things that can drive change or development. The first one is a crisis, and the second one is an incentive. So I definitely do agree with you on the need for incentives for adaptation projects, but also there is need for realization that we have been evolving, on mitigation for a very long time. The solar discourse started as early as way before the 90s, already development and innovation was already going into solar production and development. And mitigation has been discussed in the climate negotiations for a fairly long time. So it has matured over time. But adaptation, something that we've picked along the way and started prioritizing. So we need to continuously relook and understand what adaptation entails, and also understand the quick, immediate, short, long-term impacts that can be used by investors to measure adaptation, because some of the impacts are in the long term, but not to give up then we have to also ensure it in the short term. But I like your renewable distributed renewable energy systems, where you're saying the core benefits of adaptation is also an opportunity to really advance adaptation action and to bring that balance between mitigation and adaptation. Thank you for those profound reflections. And on the policy as well, we also touched on policy as a critical enabler to bring the balance, which is very appreciated. Let me move over to Kwame. Kwame, we are in Africa. We have 60% of our youth looking for jobs, coming out of universities, coming out of advanced levels and ordinary levels. Are the vocational centers working? Are they training on industrialization and green jobs? So give me and make me understand, and as well as our listeners today, to really say, how can climate finance be structured to support industrialization, and not just industrialization, but green industrialization, and also to support green jobs creation, as well as promote gender equity and local ownership?
Thank you very much, Veronica. So I think it's important for us to also place climate finance in perspective. We should look at climate finance also from the lenses of not just emissions reduction. We should look at it also strategically to drive industrialization, to drive growth and to drive development, job creation, bring about equity, and also local ownership. Now, for us to be able to structure climate finance in such a way that it supports industrialization, policies are very critical. They are very, very important. So it's integral for governments to have policies that link climate finance to industrialization and job creation. And how do we do this? One, the importance of local content and value addition. You see, across many parts of the continent, we are just producers of raw materials. The value addition is missing. And if you look at some of the frameworks that have been developed over the years, and in recent times, the Africa Continental Free Trade Area, which has created the largest trading bloc on the planet. The missing link here is value addition and encouraging trade amongst countries, 1.4 billion people. That is a huge market, but we have not tapped into that resource. So for us to take advantage of the climate finance to support industrialization, for me, we will have to look at local content and value addition. And this can be done by tying finance to requirements for using local materials, manufacturing. For instance, if you want to do a solar panel assembly, local skills will have to be built rather than shipping in panels from outside of the continent. Capacity can be built within the countries to be able to build these panels. And then in so doing, as we reduce emissions, we also create jobs, and this brings about growth and development on the continent. Africa, as we know, is heavily reliant on this agricultural sector. How do we ensure that the value chain for agriculture is developed to the extent that we have a lot of agro-processing industries that will be able to create jobs through this local content? And then also we can factor in investment into green skills development and entrepreneurship. The typical African is very entrepreneurial. What is missing is an enabling environment, access to loans, access to capital, access to the means of production. Once these are made available to the teeming African youth, there will be a lot of space for them to unleash their potential in terms of job creation and becoming entrepreneurial. And for us to be able to do this, governments and institutions need to create dedicated funding windows that attracts the best of Africa's talent, the best of Africa's youth, to use their God-given talents to be able to generate jobs and also find solutions to Africa's development. And then I would also want to factor in the gender question. You know, since in the 90s, when the issue of gender became mainstream in the development discourse, by and large, it's improved, but still a lot of lip service is paid to the gender question. How do we practically ensure that projects are designed by looking at a gender, looking at it from a gendered lens? 70% of the food that ends up on our tables are produced by African women, small scale farmers. These persons do not have access to certain resources, particularly land, finance, for them to be able to grow at scale. And when policies are being developed, it's essential that government policymakers take this into consideration and support particularly smallholder farmers to be able to increase their production levels. And then also it's important for us to create some targeted opportunities, looking at where there are growth pools, especially for women and other vulnerable groups to be able to develop. And then finally, for us to bring about climate and developmental, to meet our climate and developmental objectives, is the issue of local ownership and community benefits. I mean, this is an issue that has plagued the development landscape for a very long time, where communities are not heavily involved in particularly the planning processes for projects. Many communities are brought on board at the tail end of projects, and this does not augur well for the long-term sustainability of projects. So that kind of local content, community involvement is key to ensure that projects grow at scale and they are also able to touch very remote communities within the communities and countries. And this can only happen when there is a clear governmental policy in place. You look at some countries like Ethiopia, they have been able to develop, especially the agricultural sector, because they have included a lot of community engagements within their agricultural sector, and this has spurred growth within food production in particular. So I think this is these are a couple of ways that for policy planning, for policy implementation, many countries, many communities will be better off by including local content and also mainstreaming equity and integrity within their climate finance landscape. Thank you.
Thank you. Thank you very much. Very profound for us. How local ownership comes in, and how also can we ensure that climate finance delivers both climate and development benefits without compromising its objective. That is building on for you, Kwame. Can you reflect on that as well?
Sorry, can you repeat that? I didn't get that.
Yes, I was saying, can you also reflect on local ownership? How do we support and build on local ownership of climate finance? And also, how do we ensure that climate finance delivers both climate and development benefits without really compromising its intended objectives?
Well, I think the most critical thing is that we stop paying lip service to community involvement in programs and projects. From the very onset, communities should be brought into project implementation. they should be at the center of program development. They should lead the program development processes. More than often, we have programs that are top-down in terms of how they are framed and developed. And if we want to achieve that kind of community or local ownership, then it's important that local communities are placed at the center of it. Secondly, is one of the key means of implementation, which is also identified within the Paris Agreement, which is climate finance. Having access to this finance and at scale. Many a times, and I just mentioned a statistic earlier that just about 10% reaches local communities. We need to create a pipeline of funding that is sustainable, that is predictable for local actors to use. We have seen periods where projects that are taken to communities are stop and go kind of projects. It happens 3 years, the funder leaves, and then another funder comes in. This needs to be programmed in such a way that it is transformational over a very long period of time. So let's say 10, 15 years plus, because the benefits that we get from projects are not realized within a short period. They are often done over a long period of time. So projects should have that long-term focus. And then also the importance of strengthening local governance. There are local governance systems in place. It's critical that for us to be able to have local content and local participation, the capacity of local actors is strengthened. And this can be done through the various systems for supporting local communities and also tapping into the indigenous knowledge that local communities come up with. So I think for us to be able to ensure local ownership and community benefits, these are some of the areas that policymakers in particular and also those who work in the civil society NGO sector can also look at to ensure that communities are part and parcel of program development and its implementation. Thank you.
Okay. Wow, thank you. Thank you very much. Can I go to Adjei? Adjei, we have the question on investment. You talked about the policy and regulatory reforms, but there also has been this issue around mobilizing climate finance at scale and also looking at the aspects of enabling environment as well as looking at domestic financing. What role does domestic financing play, and how can countries unlock international financing at scale, also leveraging on their domestic resources? So just a reflection on that, and then I'll go to the Q&A session. Then I'll come back to ask you your takeaways from this meeting, opportunities like biodiversity credits, carbon markets, and of course, protecting our natural resources. So Adjei, just give us a reflection on that before we can look at the questions that we have in the Q&A section.
Thank you, Veronica. So quickly, I would note that for domestic financing, usually what I have seen work in a bit of West Africa and East Africa is that the projects, the climate projects, need to be tied to a certain underlying project. So let me give an example. You are looking at business expansion, and maybe in your expansion, definitely you are going to need power. So maybe in the expansion, the power does not become a secondary issue. It's not as if it's a standalone project. It's part of the expansion. You definitely need power to because your energy demands are going to push up once you decide to expand. So while you are looking for power, you look at a certain substitution effect where you can use either solar or something cleaner than whatever you use to power. So if it's a manufacturing firm, they are looking at maybe using solar or something cleaner to power their boiler instead of whatever traditional fossil fuel they use to power their boilers. So when you have a situation where, or if it's agriculture and you are trying to embed irrigation in your process, then you are probably looking at pumps that are powered by solar or some clean energy. So when these climate projects don't become a standalone, but they are tied to benefits or ongoing projects or underlying projects, then domestic finance, which has historically been used to do some of these things, then become a natural course. It doesn't become something we are looking for to finance climate projects. It's something we are looking for to finance something that will be financed anyway, because you are going to finance that power for whether it's irrigation, whether it's powering your factory, whatever it is. For that productive use of energy, you are definitely going to foot the bill for that power. So you are not doing climate action a favor. That is where I have seen domestic financial mobilization working very well. Even that one, local banks understand, local microfinance institutions understand, venture capitalists understand that this needs to be done. You are not doing climate action a favor. So for me, that is one way of making local finance work. Putting local finance in a context where it becomes a matter of a daily and everyday course and not something that becomes a climate action tagged finance. That is where local finance becomes easy to use. And then when you have shown a demonstration effect, it is easier then to bring in international finance, which always looks for that demonstration effect. Use local finance to start. When you have the demonstration effect, it signals international finance to also come in. Thank you.
Thank you. Thank you very much, Adjei, for that reflection. Let us leverage both domestic and international financing to address the challenge that is already there. Someone was actually saying the banks are saying we are helping you to de-risk. Are they themselves de-risked, and who is helping them to deal with the challenge? So you can imagine putting resources to de-risk cotton production, and when it's struck by the rains and before you know it, are the banks also capacitated to work and deal with that risk? So domestic financing, leveraging international financing is really key to really address these existing challenges. So we have a question from Ransford. What I'll do, I'll pose 3 questions to the panelists. You can choose any of the 3 questions, or you can have quick reflections in all the 3 questions, and we move forward. So Ransford is saying, given the limited progress on climate finance delivery through COP outcomes, should Africa continue investing heavily in the COP process, or is it time to rethink our strategy and invest more in building continental mechanisms that put African needs first? So should we really continue, or it's a waste of resources, but can we look internally instead? And then the second one is from Grace Pisirai. She says, thank you for the presentation, Mr. Kwame. You mentioned the last mile challenge. How can we design financial mechanisms to overcome the last mile barrier and ensure that climate finance directly reaches local communities, women-led organizations, and small-scale farmers who are on the front lines of climate impacts, but often have the hardest times in accessing international funding? So that is Grace saying, how do we design these financial mechanisms to ensure that that person seated at the last mile can access the funds and can address the barrier that they are facing. And Kwame, the other one says, I agree with Kwame in the definitional challenges around climate finance. But the bigger question is, who should take the lead in resolving these challenges? Is it the UNFCCC, or should Africa take the lead, including other developing regions? And do we begin with should we begin by defining and advancing their own frameworks, or should Africa and other developing regions begin to define and advance their own frameworks for what truly counts as climate finance? So should really developing countries, including Africa, take leadership to call the shots in terms of what is really climate finance? So we have three questions. One is around the COP process. The second one is around designing mechanisms that address last mile barriers. And then the third one is on the definition of climate finance and who should take leadership. So I'll start with Kwame, and then I'll move to Charlotte and then Adjei. So you can respond in that regard. Kwame, please.
Okay, thank you. I mean, these are very, very interesting comments, questions. Transford asks whether the COP is necessary. I think the evidence suggests that yes, it is necessary. There is some contestations around the format, the current format. I mean, in Dubai 2 years ago, you had almost 100,000 people coming for the COP, and it's to some extent turned into the largest gathering every year. And this year, similar numbers are expected in Brazil. When the COP started in 1995 in Berlin, the attendance was just about 2,000 people, largely made up of people who work within the environment space. But now, given the importance of climate change and its impact on communities, on businesses, on industries, you even have a lot more business people attending the COPs than the environmentalists. The question is, in the absence of such a framework or such a format, what was the alternative? Perhaps the alternative would have been dire. So I think it's important that we keep talking about climate change, even though I understand some people are giving up because year after year, a lot of pledges are made, but none of them is actually fulfilled. So it's important for particularly developing country parties to look at it from a different perspective. And I give you a very sad statistic. If you look at the sovereign funds, pension funds of African countries, they are in excess of $350 billion. And where are all these funds invested? Most of them are invested outside of the continent. So I think it's important for us to put our money where our mouth is. We need to invest on this continent. We are not investing on this continent, and we are asking others to come and invest here. So I think investing in this continent will send a very clear message, particularly to other global players, that Africa is an investment-friendly place to invest, and then they can bring in their capital to invest, because also in terms of the returns on investments, Africa is one of the highest. So I think the COP processes are important. We need to better strategize, and through the African group of negotiators on climate change, Africa has been doing a very good job going in there with a unified voice. And as has been indicated by the other colleagues initially, we need to carry on board, carry along some of our other partners, including the G77 and China, including the LDCs, and even including some of the developed country parties that are in tune with the special circumstances and needs of Africa. So I think that's an important one. And then I'd like just briefly respond on the last mile challenge. This for me has to do clearly with policy designs. And for any system to be able to function effectively, we need a kind of a structure from the top, from how policies are designed at the national level and cascade down to the local level. So this has to do with how government systems are set up to be able to track financing flows and to see where this finance ends up. So if you have a very well-structured government system or public system, it should be able to ensure that funds reach those that it is supposed to reach. So I think I'll leave it here maybe for the other colleagues to respond as well. Thank you.
Thank you. Charlotte, please, you can respond to any of the questions.
Okay. Thank you. Thank you. I'll go with the first question about the COP process, whether it's necessary. We have to go back to where the issue is before we start to look at whether to, engage in the COP process or not. First of all, we didn't cause this problem. We actually are suffering from the problem. So we have to hold the people that are the cause of the problem liable. And by doing that, we have to attend these meetings. We have to attend the COP process. So we can look at it as a two-track strategy where maybe the global stage is shape the rules concerning finance and everything, but we actually have a go in with the African-led mechanisms shaping the implementation. So before the COP, I think, initiatives like this, the African Café, you have the African Climate Summit that just finished. They come together. I think the African Group of Negotiators, they come together and, like Kwame said, come out with a unified voice that speaks for Africa. So we don't have any, we don't need to stop going there. We need to build ourselves, someone mentioned we need a facelift. We need a financial facelift, political facelift. We need to change how Africa is being viewed at the global stage to be able to, push our agenda, push our issues. So we need to go to the COP. We need to access the international funds. We need to be there. We need to negotiate. So skipping it will mean that we are missing on this money, these billions that can actually help us. Like I mentioned, we didn't cause the problem. Well, we caused, but just a little. And so going to the COP also, we get to do some networking. We partnerships, we meet donors, private sector. We all leverage all of this, network for projects across the continent. So like I mentioned, at the continental level, just the African Climate Summit that just ended, it actually came out with some resolutions, I think, targets on 300 gigawatts renewable energy. And also there've been, I think, mobilization, private sector mobilization of funds, 80 billion from development banks and all of that. So those are initiatives that shows that we are actually trying to, set the pace at the continental level, but we will not sit and miss out at the global stage. Thank you.
Thank you. Thank you very much. Adjei, please share also responses to the 3 questions briefly.
Okay, right. So first of all, on whether we should be at COP, yes, we should. It's the issue of what the economists call the tragedy of the commons. Whether you created it or not, you are bearing the consequence, and so it's that situation. So you can't choose not to be at the table where these things are going to be discussed. It affects you even if you are not the cause. Secondly, I think if we want the most out of COP, one of the things we need to start thinking about is reducing the number of decision records that come out of the COP. Last year at COP29, I realized that only for climate finance, there were about 20 decision records. You can categorize them, and then it comes down to about 8 categories of climate finance decisions. But the question is, if 100 billion has taken us that much, it was supposed to be achieved in 2020, it didn't work, it was extended to 2025, and here we are with NCQG. So the point is, can we reduce the number of proposals that are sent to the COP and rather focus on how to get the few proposals, or even go back in down history and then check the number of proposals that have gone through. Look at those that have been achieved, because I tell you, if we can achieve even 60% of the previous COP decision records we have, we probably might even have less than 10 decisions going forward in every COP. So I think that the focus should be on how we meet what decisions we've had in the past. And then for Africa, one thing we should be thinking about is you can actually have an allocation. For example, we are talking about whether we should go for a minimum allocation. You can have an allocation and not be able to use the money if there are still bottlenecks. So you can have GCF money, GEF money. There are conditions, eligibility requirements, this, that. If those barriers are not dealt with, there is going to be a mountain between allocation and disbursement. So you have money, but you can't use. So those are some of the things we should be thinking about to get the most out of COP. Thank you.
Thank you. Thank you very much, colleagues. I'll share my reflections towards the end of the meeting, but these are really profound remarks, and thank you for those reflections. There's a question by Nana. The biggest elephant in the room is whether we still have strong global traction on climate action, given the US posture under Trump. If the Copenhagen 100 billion pledge was never fully realized, does this mean the new collective quantified goal on climate finance risks being dead on arrival? Wow, that's a really deep one. And Grace comes back again and says, oh, thank you for highlighting the critical need for grant-based funding. My question builds directly on your point about targeting a certain percentage in grant funding. Given Africa's dual role as a holder of critical transition minerals and a source of high integrity carbon sinks. Wow, high integrity carbon sinks. I like that, Grace. Is it possible to have these assets strategically leveraged on, not as collateral for more debt, but as a bargaining chip to secure these essential grants? And then she goes further to give an example. She says, for instance, could access to responsibly managed mineral supply chains or carbon offset projects be formally linked to a grant-based financing stream, further creating a direct value for value exchange that reflects Africa's contribution to the climate solution? I'm tempted to stop here because it's a mouthful of questions already, but let me hear what Leslie says. She says, realistically, we cannot continue to pursue debt as a means of financing. There are sources of unlevered private capital out there, but it's frustrating when our own decision makers often ignore alternative and often look at innovative models. Who is really driving the financing mechanisms? Well done, Leslie. These are really profound questions. So, Kwame, again, reflect on the three questions on these models of financing and also the critical minerals that Africa holds, but also the high natural resources richness. Over to you.
Thank you once again. So on Nana Smith's question, on the elephant in the room, yes, indeed, that's a very big elephant. Especially with the second time withdrawal of the United States from the climate agreement, and subsequently even defunding institutions such as the UNFCCC. Well, that certainly is going to have some serious impact within the global climate finance architecture. even beyond the multilateral funding, to look at bilateral funding from the US government in support of some projects in the countries. And that is why you would expect other countries to step up onto the plate and fill in the gap. I mean, you look at the $100 billion and now the $300 billion, and based on historical antecedents, I may have to sound not too positive about reaching that $300 billion target, and now talking about 1.3 trillion by 2032. I think that's going to be quite difficult to achieve, especially if you are looking at financing from the public sector. What is important though is there's now a lot of private financing stepping up, philanthropic resources stepping up. And I think it's important that countries, policymakers engage these other innovative sources of climate finance. And as the colleagues have mentioned earlier on, the main hurdle for private sector financing is around de-risking. So once projects are de-risked, private sector can then come in, bring in the resources that they have at their disposal to support the climate actions across the globe. So it is not all doom and gloom. Even the US has left, but I think other countries could step up onto the plate. And then also with a lot of private sector financing, we should be able to do that. The other question, I think it came from, if I'm not mistaken, Grace, talking about the carbon offset projects, the carbon markets. You know, when you look at the carbon market, especially for nature-based solutions, which Africa provides in a lot of ways, we tend to just value the carbon capture potential of nature-based assets. We forget that there are other ecosystem services that these nature-based assets provide. And in many instances, these are not valued. So for instance, on what basis do you set a price of $7 per ton for carbon, when the forest also provides additional services which are not quantified? So these are some of the hard discussions that we need to have. And unfortunately, within the current global architecture, it is a toxic mix of geopolitics, climate colonialism, and other factors. So it may take time for us to really put Africa's agenda fully on the table. African leaders and particularly the negotiators have tried to put Africa's issues front and center, but I think it will need a groundswell of support from all the key actors to make Africa's case much stronger, and also advocate for Africa within the context of the global negotiations and also at the bilateral level. So, and this should also be underpinned by significant research, and that would then be able to influence the discussions that happens during the subsidiary bodies meetings and also during the COP. So the research into these areas are very important. Natural capital accounting has been said so many times, but how do we elevate that discussion onto the front burner to ensure that when we are talking biodiversity credits, we are just not talking about carbon capture. We are talking about payment for ecosystem services as well. And this, when quantified, Africa should be receiving much more than it does within both the carbon credits and then the biodiversity credits system. Thank you.
Thank you. Thank you very much for those reflections. Charlotte, do you want to reflect on any or all the three questions?
I think Nana's question on if the new collective quantified goal on climate finance risk being debt on arrival. This question is actually really very important because, like Kwame said, we've had the 100 billion goal which hasn't been met, and this leads to trust deficit where we don't really know whether these commitments, this goal of the NCQG is going to be met. And I think that there is also the issue of accessibility. Countries usually face this costly, time-consuming hurdles to access these funds. So this is us learning from, let's just say learning from the errors or the mistakes or what was not realized and what were the issues in the 100 billion goal. And then we try to come out with better strategies, maybe greater accountability, strict timelines, strict timelines, and then also ensuring legally binding pledges and promises or that. And also, I think that we could also, define the goals clearly. When the goals are clearly defined, like Adjei mentioned, we have a lot of these strategies sometimes that just, are all over the place and it's not clearly defined. And I mentioned about a unified act by the African Development Bank and the AU, where we can come out with 3, bankable projects. When it is clear, it is easy to be financed, but when it's scattered everywhere, it's difficult. So I think we have to look at the challenges that we had with the $100 billion goal, and we try to make amends and see how we can go with the new goal. We can't just sit and do nothing or just get out of these negotiations. We just have to redefine our strategies on how to go about it.
Perfect. Thank you very much. Adjei, you had the 3 questions. Please do give us your
reflection. Very tough questions indeed. First of all, on the issue of if we were not able to meet 100, how would we meet 300? What I can say is the positive is that we can target meeting the 300 earlier than whatever we could not meet in terms of years on the 100. For me, that is the best bet, to try to shorten the time. That is how I will look at it realistically. Now, coming to Grace, the minerals question in Africa is first a governance issue before it even becomes a climate issue. So I would not want to dwell too much on that. Because if I veer off from climate, then I'm going off into governance and a whole lot of other, especially if you're on the call and you've traveled through Africa, you understand where that is going. But on the grant funding bit, that is where we need to go deeper into just thinking about having a minimum quota of the NCQG, the 300 billion, because deep down, the 300 billion goes through financing mechanisms for outflows. So financial mechanisms, 3, we have the GCF, the GEF, and the L&D loss and damage fund. And then there are other mechanisms which are not financial mechanisms, where you have the LCD, the Least Development Countries Fund, and then you have the Special Climate Change Fund. These are the mechanisms that, when you look at the decision record that came from the NCQG, that is what the decision record tables. And then it goes down to now give you the instruments. And then it gives you concessional finance, it gives you grants, it gives you local currency issues, it gives you foreign currency risk instruments, and so on. So you can be given 20% as a quota for Africa. But then if the 20%, 15% of that out of 20 is on concessional loans, we all know where Africa is now. in terms of we have about 55 countries, about 21, some literature say 24 of those countries are debt distressed. So if the instrument that is a portion in that 20% quota, for the sake of the example, is concessional loans, and then you don't have a lot of grants in there. How are debt distressed sovereigns going to deal with that element? So you are not just talking about a quota, but you should be also interested in which instrument actually in the quota that you'll be getting. So the issue of grant-based funding is not just bilateral between just a donor and a recipient country in Africa, but it could also be channeled through this same NCQG angle. And this also ties into Leslie's question about an innovative private sector financing. Yes, there is, but unfortunately, Leslie, these financing in the private sector for innovative pathways are limited. Most of our financing is bank-based. So yes, there is non-hard asset collateral and so many other forms of innovative financing that we have. I agree. But mostly they are limited. And all over the world, you would notice that industrialization also hinges on venture philanthropy, where somebody takes a bet on projects, but that is also at the mercy of the level of prosperity, financial prosperity of the citizenry in the region, country, or continent. So these things are interlinked and they are not easily pinned down. Thank you.
Thank you. Thank you very much. That's very profound. I have a question here, and I'll ask you, Adjei, to take it. So kindly note it as you're going to respond. It seems that many of our leaders continue to count heavily on donor support to finance climate action. Yet across the continent, domestic budget allocations for climate action remain very limited. What other local mechanisms or budgetary instruments should we be looking for? Example, carbon taxation, green bonds, dedicated climate funds to sustainable finance, our own transition, and what should our governments do? I think you also really talked around the innovative financing. And then, Kwame, I would like you to take this one. On the issue of early risk development finance, why aren't we assuming those risks ourselves, yet hoping to retain a significant ownership stake? We need to innovate in how we mobilize development capital. And then, Charlotte, can you take the UNFCCC should lead in setting the global climate finance architecture, but Africa should lead in shaping how these resources are mobilized, allocated, and used on the continent. So in other ways, UNFCCC frameworks should have Africa for ownership. So kindly reflect on that. I know you also touched this aspect of allocation and simple access to climate finance. So you can reflect on this too. Then as you conclude, can you also have a reflection on CBAM? So one of the participants is saying, I'm really curious in terms of what our panel thinks. Does the EU carbon border adjustment mechanism offer any climate finance avenue for Africa, or it is more to our detriment and to the benefit of the Europeans? That's very sensitive and also very worth knowing. So I'm happy that you want to know the views of the panelists. It will also inform your decision making. So colleagues, as you reflect on your targeted questions and the last overall question, may you also share your last remarks before we move to the closing remarks. Thank you.
So Veronica, who is starting?
Oh, okay. Yes, Adjei, you can start. Since I started with you, please proceed.
Okay. Yes. On that question, this is what I have to say. The mechanisms that our anonymous attendee put in the in the question are laudable, but there are some of them that we can't do now. We are not there yet. For example, on carbon taxation, without going into mention of countries, we know this has suffered a lot of pushback in several African countries for obvious reasons. Yes, we could be looking at more subtle forms of taxation. For example, just 2 cents on certain products. You're talking about money that is very inelastic to the pockets of people, so that you are looking at, in aggregate, having that 2 franc, 2 cedis, 2 shillings, wherever you are, that currency, that money being so negligible and so unidentifiable that it goes unnoticed, and then in a pool at a national level, probably it becomes something substantial and can be used. But the moment it becomes so explicit and so significant, it becomes an issue and it won't fly. But for starters, we could be looking at very simple things. We have a lot of tropical regions in Africa. We have a lot of agri land and so on. So we could start looking at maybe simple things like agroforestry, where you are looking at giving seedlings out so that a farmer has their farm, but in that farm, there are a few trees to help with climate action. Very basic, low-hanging fruits. Things that don't hurt much in financing. That is what I think we can do for now, especially with the level of fiscal challenges we are facing, as well as the harsh climate impact we are facing right now. We should be looking at very low hanging fruits, easy on the pocket, easy on the fiscal budget, and so on. That is what I think we should be doing now. And then high and heavy stuff like carbon taxation and so on can come in later. But in this current African fiscal climate, some of these instruments are very laudable, but I don't think most of our economies are ready. Thank you.
Thank you, Adjei. We are already out of our time, and we'll ask colleagues to give us an additional 5 minutes as we conclude. Kwame, please respond in 1 minute, and Charlotte in 1 minute as we close the meeting. Kwame?
Okay. All right. So I'd like to talk about the CBAM. So what I foresee is, and there is a little departure from what Adjei said. I think what's going to happen in the course of time, once CBAM comes on board from early next year, countries, rather than wanting the European Union to take taxes from exports into the European Union of certain carbon-intensive materials like steel, cement, fertilizers, electricity, will rather tax their own so that they take the revenue than to give it to the European Union. So currently on the continent, with the exception of South Africa, no other country has a carbon tax. And I agree with the point that Adjei also makes, that that's additional taxation for community, for people who may not be able to afford it. So that might create some problems, but I think for the larger industry, those who will be exporting into the European Union market of these carbon-intensive products, governments are going to put mechanisms in place to ensure that rather than the EU taking taxes from their exports, the governments themselves in the host countries will take these taxes. So it's likely to open up a space for carbon taxation across several countries. It's not going to be a boom, but it's going to be a gradual process across the continent. That's my 1 minute. Thank you.
Thank you, Kwame. Charlotte?
Okay, Veronica, on the UNFCCC, I think most of these institutions are already built for, these mechanisms, funds passing through, and I don't believe in us having so many of them littered here and there. And I think the UNFCCC offers like a toolbox of full of funding mechanisms, but then the ownership comes down to those that are writing the grant proposals, who is managing the cash flow, who decides where the money goes, and all of that. And I think Africa is actually involved, because who are those that write the grant proposals? It's actually them. And then I think we need to also engage local investors. We map priorities, and then we also align this with the UNFCCC objectives. In that, so we actually create a central climate finance unit. I think the African Climate Summit came out with the African climate facility, which is supposed to be managing, I think, the 80 billion pledge by development institutions. So while the UNFCCC is like in the grand scheme of things, the funding mechanism, the ownership still comes down to Africa. So it's, like I said, it's for us to, come out with our strategies, right strategies to access these funds for our projects. And I want to also mention that this climate finance we've been talking about, it's not only the figure, So like I've been talking about needs and vulnerability, we need to understand the needs before we go to, to the global stage. We need to understand that this is not just finance that is being put in a project. This is finance that is food for the farmer that is having droughts. It's also power to schools and hospitals. You are talking about vulnerability, vulnerable and low-income communities. We are talking about green jobs and everything. So in the grand scheme of things, finance and the instruments that are being used for the financing, they all fall to, to meet up these needs. So it's for us to come out with the right strategies, the right, proposals to be able to access these funds. Thank you.
Thank you. Thank you very much, Charlotte. Thank you to our panelists. It was really indeed a rich panel, and to our participants for the amazing questions. I will not summarize any of the discussions, but I want to say I think we need another 2 hours to further engage on some of these issues. The reversal flows of climate finance, what does CIPA mean for Africa? And also the issues around restitution and reparation of climate finance. And then, of course, the issues of justice and intergenerational equity. All these are important even as we discuss climate finance. The issue of burden sharing in climate finance. So we still need more time, but allow me to move to the closing remarks, and I'll give the floor to Seth. And on my behalf, I want to really thank all of you for the amazing time that we've shared in the last 2 hours.
Thank you, Veronica. I'm just going to step in for Seth at the moment and say thank you so much. Thank you for being a part of today's ACE Cafe conversation. And on behalf of IPPG, I'd like to extend my personal sincere appreciation to you and our distinguished speakers, and to all of you in the audience for your thoughtful engagement. IPPG will be sharing the recording of this session with you in the coming weeks, and we'll also develop a reform brief based on the insights that have been shared and gathered today, which will be circulated for your reference. Your contributions have been very invaluable, and they will strengthen the collective efforts to ensure that Africa's voice and priorities remain central as we approach COP30 in Belém. So thank you once again, and we look forward to continuing this important journey with all of you. Have a good day.
Thank you.
Thank you.
Thank you, colleagues. Have a good day. Cheers.
Cheers.